Okay, now we've moved on to our percentage of sales. And a couple things I want to mention. What we're emphasizing is matching our revenues and expenses. So we're emphasizing the relationships on the income statement. And something else important to note is when we are making an adjusting entry, we disregard the existing balance and allowance for doubtful accounts. So we don't have to worry about what that existing balance is. So let's look at this problem. And this is similar to homework problem 2, part 2. When the company, Bob Company estimates 1% of net credit sales are going to become uncollectible. Sales are $100,000. Sales returns and allowances are $2,000. Allowance for doubtful accounts has $1,000 credit balance, which we don't have to really worry about, right? We don't need to worry about that. We want to compute our bad debt expense and then make the appropriate adjusting entry. So first of all, let's look at our sales, our $100,000, right? We need to subtract our sales returns and allowances. Our sales returns and allowances are $2,000. So that's giving us net sales of $98,000. And we believe 1% of those, these are net credit sales, $98,000. We believe 1% of those credit sales will not be collected. So if we multiply that by 1%, we get $980. Okay, so our bad debt expense is $980. We're going to go ahead and debit bad debt expense for $980, and we're going to go ahead and credit allowance for doubtful accounts for the $980. So this is how we do a percentage of sales. Our next example, we're going to do percentage of receivables. So what we're doing in this case, we are emphasizing the cash realizable value of our accounts receivable. The amount of the bad debt adjusting entry is going to be the difference between our required balance and our existing balance. So now their previous balance is going to come into play and we're going to have to work with it. So let's look at what we've got here. Accounts receivable, or Bob Company estimates 5% of accounts receivable will become uncollectible. Accounts receivable are $50,000 at the end of the year. Allowance for doubtful accounts is a $100 credit balance. So let's go ahead and mark allowance for doubtful accounts. It's got a $100 credit balance. Okay? So let's go ahead and do our entries. First of all, we have $50,000 of accounts receivable. We believe 5% will not be collected, so that is $2,500. Well, we already have a $100 balance, right? So we have to take that into account. So what we do, it's a credit balance, so we take $2,500, we subtract the $100 we already have in there, and that means our adjusting entry is going to be $2,400, right? So if you add this up, the 100 credit plus the $2,400 we're going to add will give us the $2,500 balance that we're trying to achieve. So we're going to go ahead and debit bad debt expense for $2,400 and go ahead and credit allowance for doubtful accounts, $2,400. Now we want to look at it a different way. What if the allowance for doubtful accounts has a $100 debit balance? So now we've got a $100 debit balance. Well, we still want it to end up totaling $2,500, right? But what are we going to have to do here to get a total of $2,500? We're going to have to add $100, right? So we're going to have our 2,500 plus we'll add 100, and that'll give us 2,600. So we're going to have bad debt expense, 2,600, allowance for doubtful accounts, 2,600. So we're going to debit bad debt expense, credit allowance for doubtful accounts for the 2,600, and when we do that, that will end up giving us a credit balance of 2,500 in our allowance for doubtful accounts, which is what we're looking for. So if we have a credit balance, we subtract the credit balance, right, to determine what our bad debt expense is going to be. And our allowance for doubtful accounts, we have to subtract it. If we have a debit balance, we have to add the debit balance, right, to what, so that we can end up with the correct amount we're looking for. In both cases, we did end up with our 2,500, which is what we were seeking. Something I just want to mention briefly here, this doesn't mean the company did something wrong, that they are, we have bad debts and they have these allowance accounts. This is pretty customary, just dealing with customers. That not necessarily do people not want to pay their bills, but things happen sometimes and they can't. So this is just a company's way of really accounting for this in the period it's incurring. So they want to look at the revenues that they've got right now and try to match these various expenses that will occur. Rather than, doing it, if this occurs 2 years from now and they write it off then, that had nothing to do with the revenues from 2 years from now. So again, they're trying to match what's going on. And that's why they're doing this at this time. But as I said, doesn't mean a company's doing anything wrong. This is just a part of doing business. Sometimes people can't pay their bills in this economy. It's happening more than ever. And it's not necessarily that people don't want to. So, that's it. We're going to move on to the next one.